So last episode, we talked about the differences between Roth and traditional retirement accounts. Um, but today we're going to go a little bit deeper. Why don't you tell us how we plan to do that?
Yeah, so we gave the good overview. If you didn't listen to it and aren't familiar with those two types of accounts for retirement savings, I'd suggest you go back and listen to our previous episode. But today we're going to run through some scenarios, just talking about some examples of when you might consider using a Roth versus a traditional. We'll also talk about the backdoor Roth if you make too much money to contribute directly to a Roth account. And then finally, we'll look at a couple scenarios where it might make sense to think about doing conversions from traditional to Roth accounts if you're in a lower tax bracket at a certain point in time. So, and then stick around to the end. We're going to, quiz each of us on, whether we would prefer a Roth account or a traditional account. And probably some caveats with that, but it's what we think. So, why don't we get to it?
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
Last week, Mike mentioned, we covered the basics of the different types of Roth and traditional retirement accounts. So it would be great if you can go back and listen to that episode, but we'll do a quick recap of Roth versus traditional. Mike, why don't you get us started?
Sure. So basically, a Roth account is after-tax money, meaning it comes off, it's income you've received, and you're going to put it into that account. With the traditional account, it is pre-tax money. So let's say you contribute $5,000 into your traditional account for the year. That would get deducted from any income you have that year. So if you make $100,000 and you contribute that $5,000, you're only going to pay taxes for that year on $95,000 of income. So generally, you use the Roth when your tax rate is lower, and the traditional when your tax rate is higher because you want to get that tax break up front.
Exactly. Now, there's one thing to add with the traditional account, and that is that you can make what they call a non-deductible contribution to a traditional IRA. So you put the money in and you don't get to deduct it. So there's not actually a tax advantage up front. Why would you do that? Well, we'll get into that a little bit later. It's most often doesn't have to be, but most often it's tied to a strategy that some people call the backdoor Roth strategy. But it's a way to just get extra money put into an account, a retirement account, even if you're not able to contribute because you make too much money to contribute to a Roth, or you make too much money to be able to deduct the contribution. So we'll get into that, but let's first start with some of the easier stuff.
Yeah, I agree. So let's talk about some of the more straightforward scenarios when you're just trying to decide, do I put money in the Roth or do I put money in the traditional account? So Amy, why don't you kick off with scenario number one?
Yeah. So let's say you're new to the military. So you're probably young, you're in your 20s or 30s. You're at a junior rank and you're probably making the least amount of money that, you're definitely making the least amount of money that you're going to make in your military career. And maybe even the least amount of money that you're going to make in your entire lifetime. This would be the perfect time that you take advantage of Roth contributions. So you're making less money, you're in a low tax bracket, and the money has a long time to grow. So it's sort of a perfect opportunity to use to take advantage of the Roth.
Exactly. And for scenario number two, let's look at the flip side. Basically, you retired from the military, you're starting to get your pension, you've taken your second career job after retirement, and maybe your spouse is working, and you're in your late 40s, 50s, probably your peak earning years. Well, that's a time when you're most likely going to benefit by deferring taxes, especially if you're going to retire, maybe in your mid 60s and have some time where you could do some conversions in the future. And so again, we'll talk about the conversion piece in a little bit, but if you're in that high tax bracket, 28, 30+% bracket, you definitely want to consider deferring taxes if you think your taxes might be lower in the future when you actually retire.
Yeah. And another time that might happen in your career, in your military career, not just, after you retire, drawing your pension, you have your second career on top of that. Another time you might be bumped into a higher bracket is if you're able to take advantage of a bonus, like continuation pay, or maybe a bonus associated with your specialty or something like that. That bonus may kick you into a much higher bracket than normal. So you might take advantage of making traditional type contributions either to your TSP, um, or to a traditional IRA. Of course, taking advantage of that TSP first, because that's where your pre-tax benefit is going to kick in if you're in that higher tax bracket, help bring down your taxable income.
Yeah, and the good thing about this decision is you can change it either each year. I mean, you could even change it, midway through the year, depending on, which you're contributing to, whether it's a workplace or your IRA. You could just decide, hey, I'm right on the line. I don't know which is better. I can contribute half of the money to the Roth side of the IRA and half of the money to the traditional. Again, as long as you're in those income brackets that you need to be. But it's very flexible and allows you to, decide, like when there's life events come up where, maybe a big bonus or something, or your spouse gets a bonus or starts a new job, it may shift your thinking of where you should be contributing. And so that's a great option.
Yeah, yeah. I mean, it's nice that you can be so flexible. So, the going back to the non-deductible contribution into a traditional IRA, again, what that means is you're putting money into this IRA. There's no tax benefit. It's sort of like a Roth in that way. But the difference is with the Roth, the money grows tax free, and then you take it out tax free. The difference with the non-deductible traditional IRA is that you will pay tax on the money when you take it out if there's been growth. So, for example, let's just pretend like you made a $5,000 non-deductible contribution to a traditional IRA. You invest the money in some index fund, and then 30 years later, you decide to take some or all of the money out. You're going to pay tax on that money except for the $5,000 you contributed. So if you take it all out, let's just pretend like, it's grown to $30,000. You're going to pay tax on 25,000. So that's 30 minus the 5. Now, why would you do that when the Roth would allow you to make that after-tax contribution and take the money out tax-free? Mike, you want to explain that?
Yeah, so there are income limits for Roth IRAs, and so that's the primary reason everybody can't just go to a Roth. And so right now, if your adjusted gross income is over $240,000 as married filing jointly, you can't contribute to the Roth. So that forces you to contribute to the traditional, which also has the limits on where you can make a deduction for that. And so that pushes people into the non-deductible uh, contribution for a traditional IRA.
Exactly. So essentially what we're saying is that the contribution to the non-deductible traditional IRA is, people talk a lot about this thing called a backdoor Roth. That is the first step to being able to convert money from a traditional IRA to a Roth IRA. So it's a conversion, but the contribution to the non-deductible IRA is the first step. But we're kind of getting a little bit ahead of ourselves. Let's talk about when this sort of scenario might make sense.
Sure. So let's say you're a recently retired military officer, your spouse is also working, you're working your second job, you're earning, combined, say $350,000 a year. Well, you're definitely over that 240 limit to be able to contribute to the Roth. And at that point, if you're already maxing your workplace plans, like your 401ks, and you still have more money that you want to continue saving for retirement, you can't go into the Roth vehicle directly. You can contribute. You make that contribution, as Amy said, to a traditional IRA. You won't be able to deduct it from your income tax that year, but it's now in that traditional IRA account.
Exactly. So, the key to this is making sure that all the record keeping is correct. So if you make that non-deductible contribution, even though there's not an impact on your taxes today, you're going to want to let your tax preparer know about that contribution or document it when you prepare your own taxes. It's documented on something called a Form 8606. So your tax preparer is familiar with this, or that your favorite tax preparation software program will generate this form for you as long as you tell the program about the contribution. The Form 8606 is how the IRS knows that you don't have to pay taxes on that money that you've already contributed because you didn't get a tax benefit when you contributed it. And this is really a crucial step because a lot of people miss this step. So they're on their way to using this strategy, but they haven't documented the contributions that they've made. And if you don't go back and fix that, then technically when you withdraw or convert this money, you're going to have to pay taxes on the full amount. So essentially you will have paid tax on the money you contributed. You didn't get a benefit. And then you're going to pay tax on that money again. And nobody wants to be taxed on money twice. So what happens, so we talked about the first step. So then the second step is at some point in the future, you decide that it's, you would prefer to have this money instead of being in a traditional IRA, you would prefer to have this money in a Roth IRA. And this is where the conversion comes in. So when you do this conversion, you're getting in touch with the custodian, so the institution holding your money, and you tell them you want to convert money from your traditional IRA directly to a Roth IRA. So when that conversion happens automatically, they're not going to withhold taxes or anything, but you are going to receive a 1099-R, so a tax form from your custodian documenting this conversion. And it's going to say that, let's pretend it's $5,000. So it's going to say that you made a distribution of $5,000 from that traditional IRA. And it's not going to say whether or not it's taxable. If you've properly filed the Form 8606 I mentioned earlier, then you're not going to pay tax on the amount you contributed. So if you put $5,000 in, at some point in the future, you decide that you would prefer to have this money in a Roth. You move it to the Roth, you get the distribution because you've documented the $5,000 already and it's a $5,000 conversion, then there's no tax.
Well, let's talk about a few of the details. So the length of time the money has to stay in the traditional IRA before you make that conversion is debated. And we suggest you talk to your tax preparer or your financial advisor to make sure that you've got their kind of blessing on the timing. There's also some debate on whether you should actually invest the money while it's waiting there or just leave it in cash. So again, talk to whomever you're getting tax advice from, and make sure that you're following their suggestions. But as Amy said, when you make that conversion, you're only going to pay on the growth of that money. So even if it's sitting in cash right now, you're earning a little bit of interest. So there may be, a couple dollars that you have to pay taxes on, but again, the bulk of that will be converted without having to pay money on it.
Exactly. And so, even though there's a debate on the timing, I mean, some people say that you can do it immediately. You put it in one day, you change it the next day. There are people who completely disagree with that. Sometimes it's months. Sometimes they want you to wait a calendar year. You need to talk with your tax advisor and make sure that you're getting good advice for your personal situation. But regardless, if the plan is that at some point you do want it to convert this money to Roth money, it's generally better if you can convert in the shortest amount of time that your tax advisor is comfortable with you doing that. And like Mike explained, it's potentially better to just leave that money in cash while you're waiting to decide whether you're going to convert or not. But if you want to invest, then like Mike said, you would only pay tax on the growth. Now, the one key point to all of this is, we've sort of attacked this. Our scenario has been that you've had this one non-deductible traditional IRA, no other IRA money out there. And that's sort of the best case scenario when you're thinking about how to do Roth conversions, or what they call a backdoor Roth. It works best if you don't have any other traditional IRAs with money in them. So if you've left a job and you've rolled your 401k into a traditional IRA, that money is all pre-tax money. And the IRS looks at that as even, so this IRA has, let's call it $100,000 from a 401k, it's all pre-tax. And then you put $5,000 in a non-deductible IRA. So now you've got 5,000 that's after-tax money and 100,000 that's pre-tax money. When you decide to do your conversion, the IRS sees that as one bucket of money, so $105,000. So they're not going to let you just move the 5,000 or convert the 5,000 to the Roth from the after-tax IRA. They treat it, so even if functionally, logistically, the money is literally coming from that non-deductible IRA to the Roth IRA, the IRS treats it as if a portion of that big IRA was actually converted. So that means a large portion of what you converted is actually going to be taxed when you do it. So for that reason, if you're thinking about using this strategy, you don't want to have a big bucket of pre-tax money sitting in an IRA. So it's best if you talk to your tax preparer or a financial planner just to make sure you understand what the impact would be. It's not that you can't do Roth conversions, but you certainly want to understand what the tax impact could be. So Mike, let's keep going with different kinds of conversions and scenarios beyond what we've just talked about.
Sure. So we talked about the Backdoor Roth. Now we're going to get into just the relatively more straightforward conversions, and just assume that you have that traditional account that you've been saving in for, many years. Typically, your 401k, your high earning years, maybe you're putting your money in there, or the TSP, and it's grown in size. You've got several $100,000, maybe close to $1 million in there now. Well, that's a big tax bill that's sitting out there. And eventually, Uncle Sam wants his money. And, in the out years, now in your 70s, you get forced to take a distribution because of that. So, what do? Well, if there is a time, maybe before you start taking Social Security, you retire, your income drops, and all you have is your pension coming in, that can make a great time to consider making a conversion and taking money out of the traditional side and just moving it over into a Roth side. Pay the taxes, but again, if your income's lower, you'll pay at a lower rate. So, example, dual military couple, both retired, have large TSP balances. They pushed it all into the traditional side, basically because they were, they had two incomes coming in at all times. And they're 60 now. They don't really need to work anymore. They decide they're going to, hang it up and start traveling the world, and figure they'll wait and defer Social Security to at least full retirement age, 67, maybe even all the way to 70. But they've got those 7 years where all they're going to have coming in is their pension, so they're going to drop down into a relatively low tax bracket, probably the lowest they will be for the rest of their lives. And um, that can make great sense to start doing conversions where they're taking money out of that TSP account and pushing it into a Roth IRA and just paying the taxes on it. And if they break it up over those 7 years, they could probably get a lot of that money out at a relatively low tax rate.
Exactly. And so logistically, the way this works, using this example where you have two retired military spouses, most of their wealth is in the thrift savings plan. They use the traditional version, so the pre-tax version. Um, in order to do the Roth conversions, like you explained, Mike, in order to do that, you actually can't do it inside of TSP. So what you would do is you would open a Roth IRA at your favorite custodian, so some institution that you want to work with. Open that Roth IRA, and then you would request a distribution from TSP for the amount that you want to convert. So, um, let's just pretend like you're going to convert $50,000. So you would request that distribution. TSP would send it to the custodian. And now TSP is going to generate a 1099-R, so that tax form to tell the IRS that you've taken a distribution and you're going to go ahead and pay tax on that amount of money, but it's still in the retirement account, and it's going to be able to continue growing tax free, and you're going to be able to take it out tax free later because now it's Roth money. So it seems counterintuitive to agree to pay this tax sooner, but keep in mind in our example, you're at a lower tax rate than you will probably be in for the rest of your life. And this takes a little bit of understanding how taxes work and being able to project things over time, to know that you are likely in a lower bracket, and therefore you're choosing to pay taxes at that lower bracket instead of at your higher anticipated rate later.
Yeah, exactly. It's important to understand that this takes a lot of analysis. Understanding, your current tax bracket, where you're going to be in the future, considering some things like, what happens, especially if you've got an age difference, when the first spouse dies, or maybe someone's not in good health and now they're back in the single bracket. If money's going to be left to children, what tax brackets are they in? So very complicated. Nobody's got a crystal ball on what Congress is going to do with tax rates. So it's really the best guess of where you think you'll be, where you think tax rates will be. And, but this often makes a lot of sense based on, what we know today. This strategy can make a lot of sense and, really save you hundreds of thousands of dollars in some cases if you've got a very large, 401k, TSP, traditional IRA. Those taxes will, later in life can be significant. So
Yeah. And there are so many factors that might change the landscape. I mean, um, current tax rates, the reality is our current tax rates are historically low. But that doesn't mean they're going to go up. They might not. I think that everybody is aware of the fact that we're carrying more debt as a percent of GDP than ever in our nation's history. We're going to have to leave it to the politicians to figure out how we're going to handle dealing with this. Is it going to be tax increases? Is it going to be something else? But that's for politicians. That's for economists to sort out. We mere mortals trying to make decisions for ourselves day to day. We have to make the best decisions we can with the information we have available at the time. It's not perfect. It'll never be a perfect science because we can't know the future, but we have to make the best decision with the info we have.
Exactly. So, Amy, we've talked about a few scenarios, just basically when to, possibly contribute to either type of account. We've talked through the backdoor Roth and also conversions. So just curious if you had a default, what would you recommend, you know, give some caveats or however you want to frame it, but do you prefer Roth or do you prefer traditional?
Yeah. Oh, that's a good question. And honestly, I think a lot of people do leave this decision to a default. They just kind of use rule of thumb. And oftentimes that default is pre-tax or traditional contributions to their 401k or thrift savings plan. Of course, every recommendation we make has to be tailored to an individual. So this isn't a recommendation. But if I was forced to suggest like what a default would be, um, I I think I'd have to go with the Roth, especially for somebody who's younger, like less than age 50, let's say. And part of my logic there is that, once you hit your 50s, oftentimes, particularly for military folks who retire and take a second career, when you're in your 50s, you're probably in your highest earning years. Um, but before that, there's a good chance that you're in, a lower bracket than you might ever be in. So we can't know. Um, but just, speaking in generalities, I think I would default to the Roth. Also because, as I mentioned before, I think we're at historically low rates. We have a big national debt. I'm not really sure how we manage to balance those books without raising taxes at some point. I might be wrong. Again, that's for politicians and economists to work out. Um, but I think I prefer to know that, to pick the devil I know, which is pay the tax of the rate that I know versus the devil I've yet to meet, which is to not know what my tax rate's going to be in the future. So I think if I had to pick a default, not a recommendation to anybody out there, but I think if I had to pick a default, I'd pick a Roth IRA. What about you, Mike?
Yeah, for a lot of reasons, I'm a big fan of the Roth, and I think that the age thing is good. I mean, the other piece you can look at is when you file your taxes for we just finished tax filing season. Go back and look. Typically, like on the front page of something you get back from your accountant or get it out of any of the tax preparation software, it tells you what bracket you're in and what your effective tax rate is. If those are low, if those are, 22, if you're in the 22% tax bracket or lower, I have a hard time telling people not to, recommending they possibly go into the Roth side. It's low, like you said. I don't know how we get to the future and don't bankrupt our kids if we're not, it's at least in some ways, raising taxes at some point. Um, so look at that, look at what your effective tax rate is and what your tax bracket is, and make the decision. I hate when I see, people come in, they've been in the military 15 or so years, and didn't have, the spouse wasn't working, so it was just a military income coming in. and they've been doing traditional the whole time to get that tax break. That pains me because I'm like, oh, you were paying at such low rates those first few years that it would have been so much better had you been putting that in Roth. But so again, age is a good gauge, but really just looking at your income and your tax rate and making that educated guess. And like I said, if you're borderline, if you're in that 22% or pushing the top of that, maybe you split it. Maybe you do a little bit in one and a little bit in the other. So
Yeah, and that's a really great point, trying to take a look at where you are, and and that's sort of the trick. And so you've heard our default, sort of where we might default, not recommendations for you specifically. But I think what I'd really like for you to take away from that is not to leave it to default. We would rather you make an informed decision. We've talked about, how complicated it can be, and we've talked about tax brackets and, if this and then that, and there's a lot that goes into this decision, so it's a little complicated. But we're here for your questions. Drop us a line. But be proactive. Try to make a good choice rather than letting some default, which tends to be sort of the traditional. But don't do things by default. Make an informed decision.
well, we definitely appreciate you listening. Hopefully, these two episodes on traditional versus Roth have been informative, and you've learned something. And like Amy said, if you have any questions, you can definitely drop us a line and let us know, and we'll be happy to address them possibly in a future show. So, Amy, it was great talking to you. Look forward to doing this again in a couple weeks.
Sounds good, Mike. See you then.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com.